cash and cash equivalents. Come on, mouse. These are literal cash, your vault cash, and the demand deposits kind of stuff you have in the banks. Obviously, these are most liquid. If you have a checking account at the bank, you can access it anytime you want. So that's the most liquid. Then you have short-term investments. Generally, these tend to be short-term uh, treasury kind of securities or commercial paper, which is basically short-term bonds, short-term bills that are issued by corporations. But every once in a while, you have investments in stocks like that. If you buy 10 shares of Google, that would be a short-term investment. I don't want to go into the accounting detail. When you have equity kind of investments, you can designate them into three things: available for sale, uh, held to maturity, and some other thing. But this is not a class we're going to talk about that. Uh, these are financial assets, typically financial assets. Uh, that can be easily sold, such as short-term T-bills, non-controlling interest in stocks. If you have 1,000 shares of Google, you can get rid of that within probably 1 microsecond if you let your computer do the trading for you. But if you have 10 million shares of Google or 1 billion shares of Google, that may not be that easy. So we wouldn't classify them as short-term investments. Just to give you an idea how big they can be, when I want to look at things quick and dirty, I look at FinanceYahoo.com. For actual financial statements, I'm going to show you guys how to use SEC website. So let's find Google. Financials. Let's look at the uh, balance sheet. And I want to do it quarterly. This is as of their last financial statement. Total assets listed in the books as 414 billion. Current assets are about 162. Of those, 100 billion is cash equivalents, and short-term investments. That's a lot of money. The entire market value of Google is less than 2 trillion, I believe. Let's see. Market cap, yeah, 196 as of now. Let's go back to financials. But we also have some other things. One of them is so-called receivables. Technically speaking, these are amounts that is owned to the company by its clients. And these are amounts that do not carry any interest. These are non-interest bearing receivables. If a receivable is bearing interest on it, that is called notes receivable. They tend to be for longer term. Accounts receivable are essentially either the stuff your clients buy from you on credit, right, on short-term credit. A lot of times you make the sale with a credit card, but the credit card company takes about a week to pay you. That would also be part of that. But in general, accounts receivable tend to be a little bit less liquid, even though they're pretty liquid assets. They're not as liquid as cash and short-term investments. There are two reasons. One, let's say somebody owes you money and they're supposed to pay in 30 days. Well, you're going to have to wait for 30 days. If you force them to pay earlier than 30 days, they're going to ask for a discount. So, in that sense, it loses liquidity a little bit. Or just because it is a receivable does not necessarily mean that it's going to be received. You may not be able to collect it. You know, we all owe money to credit cards. Sometimes we can pay, sometimes we can't. So there is a chance that you may not be able to collect those receivables. And in fact, whenever companies recognize that they may not be able to collect the receivable, they declare that as a doubtful receivable, and that is actually deducted from the receivables. So what the number you see is the net amount. If you look at the detailed stuff, you would see the allowance for doubtful receivables, but you're not going to see that in a Yahoo financial statement. Oh, maybe you do. Yeah, there it is. People owe Google about $48 billion in receivables. They think that about a little bit less than a billion of that is doubtful. They recognize that as uncollectible. That doesn't necessarily mean that all that 850 is lost, but they act as if it's lost. One of the principles we have in accounting is to be conservative. If the chances of receiving not receiving is relatively high, we're going to declare that doubtful receivable. If you later collect that, in fact, that difference is going to be recognized as income. It's kind of one-time income, but later it's going to be recognized as income. And next we have inventory. These are the goods the company has. They have produced it, but they have not sold it yet. I don't know what Google has in inventory. In fact, it looks like zero because Google doesn't have anything that are on the shelves. But if you were looking to a company like Apple, by the way, in Yahoo Finance, you can just change the name, ticker of the company, and get the same thing. For example, Apple has about $6 billion in inventory. These are probably stuff that they already put in the Apple stores or they haven't yet shipped to other vendors. We always would view inventory as less liquid than receivables. A, we don't know how long it's going to be take to sell those, and B, we don't know whether or not we'll be able to sell it at the book value. And typically, the book value of inventories is the so-called cost of goods sold, less or lesser of cost of goods sold, or the historical cost and market value. Because of your accounting system, you may think that that iPhone costs you $200 to produce, but if you can get only 150 in the market, you use 150. But if you think you can get to 50, you still use 200. As I said, accountants are conservative bunch. If they have no meaningful and consistent way of attaching a value to something, they choose not to. That's why you have no item called Steve Jobs in Apple, or whatever the name of that guy in Nvidia, the new mega billionaire. I think in 20 years he's going to be trillionaire, but who knows? He keeps selling some stocks, but he also gets a lot from the options. And almost always you have other current assets. There's numerous to list, but some of the current assets are prepaid stuff. Suppose you have an agreement with your customers, and they're going to deliver machinery to you in 1 year, but you already paid it to them. Technically speaking, since you haven't gotten it, it is not an asset, but you paid for it. Since you paid for it, it's prepaid assets. So that is an asset. It's something you own. Because if they don't deliver, they're going to have to pay you back, right? And if they do deliver, then you'll have the assets. Now, on the liability side, and without necessarily knowing the details of what's in other current assets, we just list it at the end. Not necessarily because the other stuff is the least liquid of the current assets. It's because you don't have information to classify them for anything otherwise. Uh, Total liabilities are divided into, I'm sorry, fixed assets or net fixed assets. These are things like plant, property, equipment, sometimes known as PPE,